Welcome to a case study we did at the Southwest Florida Real Estate Investment Association for the June luncheon. It was understanding cash flow in a boom-bust market. Disclosure: none of this is to be deemed investment or real estate advice. Please rely on advice from competent and licensed professionals before trying to do this at home. As always, do your own research. Only accept what you can prove for yourself that works within your own narrative and your own goals. About this case study, we took a single family residential house, which is what most new investors tend to do, and we looked at it two approaches: buying at the top of the boom, following the herd, or buying at or near the bottom of the bust. Leap of faith is basically. We did calculations based upon a leveraged and a cash sale. The leverage sale was an 80 LTV loan at 6%. This was the most conservative leveraged investor in 2006 you could find. This is more scientific and theoretical in nature. This was more just to understand the percentages up and down. I wouldn't take this to try and put this in motion with anything but the principles of it. How we structured the analysis. What we did is we took a house in Cape Coral. Now, a client of mine bought this house that we currently manage, so we know what it currently rents for and what it did rent for in the past. On the 2006 purchase, we use a $210,000 purchase price with 20% down at 6% interest. The 2009 purchase, we used a $60,000 purchase price with 20% down and 6% interest. Okay, due to the time constraints of this presentation, we're only looking at investments on a cash-on-cash perspective only. The 2006 Cape Coral purchase, okay, the guy that bought in the boom, what's interesting is that the unleveraged purchase, the guy that paid cash, his best year was 4.34%. His worst year in 2008 was 1.91%, which, all things considering, if he didn't have to sell, which means he didn't affect his principal balance, the cash guy who bought at the top of the boom actually made money, which is the most interesting thing. Now, we also used, RIA members have what's called an APOD. It's built as a collaboration amongst a few members. It's an annual property operating data. That's how we determine these numbers. It gives you true cash flow. In most coastal markets, particularly Southwest Florida, the 1% rule, the 50% rule, all those rules don't work here. You need to do the math, and it's simple math that works. We don't even factor in depreciation. We don't factor any tax benefits. All we're looking at is strictly the simple math. How much is at the bottom of the funnel at the end of the month or year? Now, the leveraged guy in 2006, his best return was a negative 5.57%, and then it went to 12, then 14, then 13. It's not a very good investment. It doesn't even really qualify as an investment because your immediate return of your immediate rate of return is strictly based upon gain, because and not only with that, the first year you would have had to cover 5.57% of loss to carry it. Now, the 2009 purchase, leveraged and unleveraged. The leveraged guy in 09 is making 11%. Okay, in 2010 he made 6. In 2011, 15. 2012, 48%. Now, what we did is we took the same taxes and insurance that on the downslide and laid them in the other direction on the upward swinging, assuming we're going to replay the same market that we just had. Now, bear in mind that especially on the taxation, they have capped at 10% a year for Lee County. So again, this is more theoretical in nature. Now, the unleveraged guy immediately was making 7.7% a year cash on cash, which is twice what a CD would pay him. And not to mention, he bought under replacement cost if he bought in 09. 2010, 7.71. In 2011, 8. 2012, which would be the peak, which would be 06 if you flipped it around, you make 15% on your money. That's a pretty good return. It'd be awful hard to convince that guy at the peak of the market to sell when he's making 15% on his cash. Now, as rents go up and down, taxes and insurance do as well, just a little slower because they're basically in arrears. And this is a percentage of taxes and insurance in relation to gross rent. Now, 2007, you had a softening market, but the tax collector was using the sales from 2006, which is why you have such a large jump. Things of note, and this is the really most important thing: when the market crashed in 2007, it was very apparent something was wrong. Taxes and insurance went up 27.22%, while rents went down 25%. So in 1 year, from 06 to 07, you lost 52% of your cash flow. Now, the 2006 cash investors still got a rate of return no matter what, just as long as they didn't have to sell it. Now, the guy that bought at peak pricing with leverage was toast from the moment they bought it. The 2009 leverage investor will get great returns at the top of the next cycle. I will bet they're going to resist selling over when they're making 40% on the money they put down. Now, the key to be is when you buy right and the market goes up, to not refi into the current pricing. Bear in mind, I didn't say value. There's price versus value. And you have to at all times resist the urge of what this study showed to refinance, take the money out, and now you're the same as the guys who just bought. Things to remember: the largest expense you're going to have is taxes. Taxes are always assessed off last year's sales. Okay, this is a lagging indicator. This works before and against you. It just depends on what cycle and at what part of the cycle you're in, whether you're on the left side or the right side of the bell. And always remember, when you're in real estate, busts don't follow booms, booms follow busts. That's when the real money is made, in the busts. Thank you for watching this video. If you have any questions, you can always give me a call at 239-671-8248. You can also visit the RIA's website at www.swflreia.com. The homepage is a running narrative of what the Southwest Florida real estate market has been through in the last few years. You can also add yourself to our mailing lists. Thank you for watching this video, and I hope you have a great day.